Hey everyone, how's it going? That was the closing bell for today, January 3rd, and we got a very directional day today, very much negative to the downside. So let's take a look at how that looks and what that means for us in terms of all the indices. So SPY, actually, let's look intraday first. So we can see that we started down, we had some kind of sideways volatility, and then we really started to get directionally downward again, starting at around 11:30. So that means the report, that FOMC minutes, we had an initial negative reaction, and then we recovered, but then we started trading back down again. So I didn't personally get a chance to look at any of the FOMC minutes to see what they said, but just from the market reaction, we took it as a little bit of a trap. We traded down, went all the way back up, and then traded straight back down again. So TLT would probably give us a better idea of that reaction. So a much stronger reaction in TLT. So TLT trading back up and then not trading back down quite as much from that report. So overall, actually, let's take a look at our probabilities, see how those changed. Okay, so 91% today in terms of not having a rate change in January. So that is increased 4%, almost 3.5%. And then in March, what we see is yesterday had that combined 80%, and today now we're at 70%. So we did move even lower from this morning. We started at about 75%, now we're at 70%. So that probability is moving lower and lower, and we're seeing that reaction happen in the downward movement of the indices. So the S&P 500 now closed at the EMA 20 at 468.31, and we're closing at 468.75. So almost at the EMA 20. That is a pullback. So all this time I kept saying we hit the +3 ATR, then we would look for a pullback into at least a +1 ATR. So here, when we hit the +3 ATR, we just traded sideways until we hit the +1 ATR. And then we went above the +3 ATR again and stayed up there until now we're at the EMA 20, so beyond the +3 or +1 ATR. So we are pulling back. Does the S&P bounce from the EMA 20 here? Well, the NASDAQ didn't yesterday. The NASDAQ kept on going. So QQQ fell right through that EMA 20. And did we draw lines? We did draw lines, these blue lines. So we don't really have good support until these blue lines over here. So there is a lot more room for this NASDAQ to keep on coming down. And if NASDAQ keeps on coming down, then that is for sure going to drag the SPY down with it. Because even if the Dow Jones continues moving upwards, which at this point doesn't look like it's going to, it wouldn't be able to balance the pull of the NASDAQ. The NASDAQ is bigger, much bigger than the Dow Jones. So Dow Jones fell through the EMA 8. So what's looking like a possible scenario right now is the Dow Jones pulls back to the EMA 20 or to this blue line that we had right here, which is the previous all-time high. Okay, so we could pull all the way back to that EMA 20 or that previous all-time high. That would be associated with a sharper downward movement in QQQ all the way down to this blue line. And that would mean the S&P 500 would also pull back down to this purple line right here. So we are looking like it is a very strong possibility that we are going to pull back at least that far. And that would be a real pullback because the S&P, if we just come down to the EMA 20, that's a 2%. And generally pullbacks we would expect it to have maximum downward movement of about 5%. And that would be, well, that would be beyond these purple lines. Actually, 5% would be almost to the MA50 right here. So it's just a pullback. To the purple would just be about 3.5 to 4%. So that would be a healthy pullback, and then we could resume our motion upwards. So we should start planning. Our portfolios should be starting to lean just to the short side of neutral. And so overall, the trend is still up, so we don't want to go completely bearish. We would just be neutral or just a tiny bit short. Again, the S&P could bounce from the EMA 20 from here. That's possible, but because the QQQ didn't, and because bonds are still moving downward, see TLT came and touched the. Oh, we already touched. Oh, that's interesting. So we opened at the EMA 200 and EMA 20. We bounced off of it and went all the way back up to the EMA 8. That's interesting. Okay. I guess I missed that when we looked earlier. I thought I looked at the TLT. So we did end up higher. So we'll see. If this bounces from here and goes up, then that QQQ pullback isn't quite as definitive. So we still do have a little bit of uncertainty in here in these markets. But right now it does look a little bit more like we're going to keep on pulling back. So I would be neutral. Rather than slightly short of neutral, I would just say neutral in this environment. I would just stay as flat as possible, delta neutral in my accounts. And that means the best way to take advantage of this particular environment is mostly spreads. Okay, I was going to say that you could sell, but mostly you want to do spreads. If you buy something, sell something. If you sell something, buy something. Just make sure that on a delta standpoint, you're mostly neutral. Okay. Let's see what happened in terms of our sectors. Did our XLV, XLP, and XLU, are those still our top performers? XLV pulled back a little bit. So we did start out higher, but that low and the close is below yesterday's close. So we are down a little bit on XLV, 0.19. So we were saying how that was a little overextended or overdone. Looks like we were either going to pause or pull back from here. XLP, same thing. Our low went back below that MA200. So we are not confident in the continued upward movement in XLP just quite yet. You could pull back, touch that EMA 8, touch that EMA 20, and bounce again. So it has been an uptrend. And we can see after this crossover right here, we did come and touch the EMA 20, almost touched the EMA 20, touched the EMA 20, touched the EMA 20, went through the EMA 20, and now we're starting to pull back again. So at least on this particular upward trend that we're seeing in the XLP, we've seen a lot of pullbacks to the EMA 20. So this could come back and touch that EMA 20 again. And then we'll look at XLU. XLU is hugging that MA 200. I'll also look at XLE because XLE is energies are more of a commodity. They're not really highly correlated with the stock market. And it looks like we had a really strong day in XLE today, 1.6% upwards, and above all the moving averages except for that MA 90. Okay, so let's take a closer look at our sectors. So energies up 1.78%, XLU barely up 0.16%, and everything else was down. So the sector-wide downward movement, and so the entire market is pulling back. For sure, the retail, looks like real estate and home builders, consumer discretionary, tech, those are all definitely down significantly more than other sectors. But this is across the board. There's no, other than XLE and XLU, there is nothing that stayed up. Let's take a look at momentum levels, and then we'll see what we can conclude other than we should be neutral. I should take a look at volatility as well. Just want to see if there's any abnormal gaps. Staples still has an abnormal gap. Healthcare still has an abnormal gap. So looking like, and utilities. So staples, healthcare, utilities, the exact same thing. So those are still our best opportunities in terms of the upside, but you want to balance them out with downside movement. So, or if you want to play the pullback, then you balance it out with longs in one of these three sectors. And then we wanted to look at VIX. Okay, volatility up, but not hugely up. We're looks like at 14.03. We're not going to get too excited until at least this 15 to 16 region. So this definitely has a lot more potential room to go. And if that happens, then the S&P can move down a lot more. So the only thing that's not quite lining up right now is the TLT. The prices are going up, rates are coming down, or our expectation of rates is still down. So this TLT movement seems contra the probability movement, and is also contra what we saw from the minutes, and is contra for what we saw in terms of the movement of all the major indices. So I'm not really too sure what's happening with TLT. We'll see what happens to it tomorrow. Do we get it? Does it come back down and realign itself with all the other things that we're seeing, or does it keep going against it? So I would expect it to realign. It would be very unusual for this to start going upwards while the Nasdaq and the S&P keep coming downwards, especially if these probabilities keep coming downwards. So we'll just have to see. That's the one piece of the puzzle that doesn't quite fit and that is giving us a little bit of doubt of what's actually happening right here. But everything else is pointing towards pullback. And so we would still align ourselves that way. So we go mostly neutral. And if we decide that we want to play some things pulling back, just recognize that it is a counter trend position, and therefore it's a little bit riskier. And so we would definitely want hedges against it. I think that is about it. Let me see. There's something else for me to look at. CPC, we haven't looked at that in a while. CPC is at 0.94, so that's not really telling us anything. And then let's see when earnings are starting to go. I don't think earnings start for another month or so. And then, oh, there's this fear and greed index, CNN fear and greed index. They put together a lot of different indicators. So right here, they tell you what they are: junk bond demand, safe haven demand, market volatility, put and call ratio, stock price breadth, relative strength, and market momentum. All of those combined, they create that together, their own proprietary way of blending those together and deciding if the market is in extreme fear, neutral, greed, or extreme greed. We just today passed back down into greed. So all through November, we were greed. In December, for the first 1 or 2 weeks, we were in greed. And then towards the end of December, we were in extreme greed. You can see that 1 week ago, it said 76. 1 week ago, yesterday, it was at 80. So we were in extreme greed, and we're starting to fall back down into this greed region. So in a real pullback, we would see this slip all the way down towards the bottom end of greed or neutral. So like I said, I don't think anyone is at fear. No one is thinking that we're going to pull back go to bear market. Pull back, it's normal. Bear market would cause fear. So no one's in that fear mode just quite yet. So we do still have quite a bit of room to move downwards for a pullback, for a normal pullback. That reminds me, I just reminded myself of something and then just completely forgot about what it was again. Oh, got it. This morning, we talked about the 2024 expected move. And I said how, based on that expected move, the market is not pricing in the possibility of a bear market in 2024. And it's actually, I was surprised by the range of the expected move, because normally I would have expected it to be larger. And so what we're seeing is collapsing volatility, which is very, very interesting to note, because let's take a look at what we actually got, for example, from, we'll just say 2020 to 2021. So I want to see the range actually. So I should go, this was COVID, so this might not be a fair comparison actually. So, but this was a 153 point move, and then 2021 to 2022, that's a 120 point move. And then from 2022 to 2023, we had a 130 point move. And then from 2023 to 2024, we had a 102 point move, or about it, just call it a 100-point move. So the past several years, ever since COVID, we've always had a 100-point move in the market. And we saw this morning that the expectation for the market this year is only 63. That's 60% of the smallest move in the past several years. So that's really interesting to note. What it means is we are expecting a lot less volatility, a lot more certainty in the markets, which would point towards upward movement, a predictable, steady upward movement. So everything that is priced in the market right now is all pointing towards a higher probability of a bullish 2024. But again, I expect a pullback or correction near the beginning, and it looks like we might be getting it right now. We might not. We could, if we just go down to this purple line right here, that might be an initial relief. But remember, in any given year, we expect at least 1 to 2, 5 to 10% corrections. If we only go to these purple lines, that was only 4%. So we would expect to, if we're going to get that strong pullback or correction right at the beginning of the year, then we would expect a pullback actually to the MA50. So that would be much deeper than what we're talking about right now, at least what we foresee at the moment. We'll see as the next 1 or 2 months, not 1 or 2 months, 1 or 2 weeks develop, we'll see just how far this pullback goes. It could be short-lived. Given the strength that we've had lately, there might still be a lot of exuberance left over, and we could move a little bit higher, make all-time highs before we have that pullback. Also, given the fact that we're at a holiday week and we don't have 100% participation back in the markets quite yet, that could indicate that the pullback move that we're expecting, the 5 to 10% correction that we are expecting, could be later on rather than right now as well. So that's what I'm looking at right now. The possibility of at least a 3 or 4% pullback is very strong right now. It could turn into that 5 or 10% correction, but for now we're just looking at 3 to 4%. We're going to position ourselves very carefully. We're not going to get too long, and then just balance your portfolios accordingly. So we'll see what tomorrow brings, see if that S&P breaks below that EMA 20. If it does, that's a very good sign that we'll continue down to these 2 purple lines over here. All right, guys, have a wonderful rest of your night, and I'll see you tomorrow morning.